Hello and welcome to this Capital Economics webinar, Are Cracks Beginning to Appear in European Property Markets? My name is Hamish Smith and I'm joined by my colleague today, Kiran Raichura. Between us, we cover 31 cities in our European Commercial Property Service. This excludes the UK, which is covered separately in our equivalent UK Commercial Property Service. Following a presentation of around 20 minutes, we'll have time for a short Q&A session. We have received some questions already, but if you do have a question as we go through the presentation, please click the Q&A tab on your screen and submit it to us. We'll try and answer as many questions as we can in the time available, but if we do run out of time, we'll follow up with an email response. We have also included a couple of our recent updates, along with our key calls for 2018, which you can download directly today by clicking on the Resources List button. We also released our latest Eurozone and non-Eurozone analyst forecast documents at the start of this month, and they can be found on the Capital Economics website in case anyone has missed them. Right, in terms of today's presentation, Kiran and I will look at whether some recent data suggests that cracks might be about to appear, and if the tide is about to turn for the European commercial property market. We will also briefly outline what we think the outlook for the economic environment means for the asset class in the coming years. So I'll hand over to Kiran, who will take us through some of the recent market trends.
Thanks. I'm going to start with a bit of context for our concerns, and that's a decline in our valuation measure in the last year. Here you can see that in the last 12 months, valuations have become more and more stretched over time across all three sectors. In fact, to the point that the office and industrial sectors both look overvalued. And in fact, Q1 2018 was the first time in this cycle that the majority of our 93 markets were overvalued. But approaching, but not quite at the midpoint of the year, clear evidence of a softening market would inevitably be difficult to find. But there is a degree of support for our assertion back in January that the prime market had passed its peak in terms of investment activity, rate of inward yield shift, and capital growth, although rental growth is yet to join this party. So, the evidence. Well, the year started with a usual seasonal fallback in investment activity when compared to Q4 2017. But this chart shows Q1 investment transactions compared to Q1 of 2017. The news here is better, although overall European investment activity was down by a couple of percent, driven by a 7% fall in the UK and a nearly 30% drop in Scandinavia. The Eurozone and emerging European markets saw year-on-year growth, however. To get a fuller picture of the directional trend, we can instead look at the four-quarter rolling sum of investment activity in the key sub-regions. You can see here that over the last 8 years, there's been a steady upwards trend in all three regions. However, if we look in more detail at the last few quarters, we can draw out three differing stories. Top of the table is the CEE region, where activity is growing each quarter and reached over 20 billion euros on a four-quarter basis. We think investment will again set a new record this year. Currently wavering and showing signs of plateauing is the Eurozone, shown here in blue, where the rolling four-quarter sum has not been able to match the Q3 17 level in either of the last two quarters. And finally, in the relegation zone is Scandinavia, where investment activity seems to have peaked in early 2017. To be more specific, at a country level, while Norway investment has flatlined since then, and Denmark investment grew strongly last year, Sweden investment totals are down substantially, having fallen 36% in the last 12 months. And that's despite average capital values having risen by more than 5% in the last year. So how has a slowing investment market impacted upon property yields? Well, at the all-property level, yields continued to fall in all sub-regions in the first quarter. 3 basis points fall that you can see for the Eurozone here kept the year-on-year fall close to 20 basis points. But there's been a clear slowdown in those yield falls in recent quarters, particularly in core markets in the office and retail sectors. That trend is highlighted more clearly here, where you can see that the quarterly Eurozone all-property yield shift accelerated through 2013 to 15, but has since slowed to the point of almost stopping. Echoing that is the fact that the number of markets in which yields are falling has dropped significantly. So in 17 of our 31 office markets, yields have actually been flat or fallen by only single digits over the last 6 months. We firmly believe that we're now nearing the end of the road for yield falls in developed Europe, although this is a couple of years later than many analysts were calling the end of yield falls. Interestingly, the slowdown in momentum in the investment market hasn't been echoed in a slowdown in rental values, for now at least. Office and retail rental growth has mostly been solid over the past year. There have been a few notable exceptions though, not least in German retail and Vienna offices in recent quarters. And while the industrial sector is a bit more patchy, it did at least produce decent rental growth in Q1. That being said, there are reasons to think that this might not be sustainable. So if we look at measures of economic activity such as the purchasing managers indices, they've weakened substantially in recent months. This chart shows the drop-off in the Eurozone PMI and the correlation with GDP growth, suggesting it unlikely that we'll see an improvement in growth in Q2. But measures of economic sentiment have also softened in Scandinavia, Switzerland, the UK, and Central and Eastern Europe. So it looks like economic activity may have also peaked. Indeed, our forecasts point to a gradual slowing in Eurozone GDP growth in each of the next 3 years, as you can see here. We expect a not too dissimilar slowdown in economic growth in Scandinavia. Even so, in the case of the Eurozone, growth will still be above its 15-year average. The slowdown is likely to be far more pronounced in the CEE region, as interest rate hikes and tighter fiscal policy take the steam out of the consumer sector in particular. Slower global growth will also dent export growth. This projected slowdown in economic growth has implications for property occupier markets. This slide shows the relationship between GDP growth and the change in office take-up for the Eurozone. Although take-up has been particularly volatile in recent times, it has still tended to follow the trend implied by GDP growth. It follows, therefore, that if GDP growth slows as we expect, then take-up would grow at a slower pace. That said, according to the relationship, it would take GDP growth to drop back to below 1% before annual take-up volumes fell. What's more, if we look at the supply side of the office equation, in general, pipelines are not especially large. Here you can see that over the next 3 years, most markets have no more than 4% net additions. Dublin is the major exception, where the amount of new stock being delivered in the next few years has led us to forecast rental falls of 5% next year and 2 to 3% in 2020. We expect large pipelines in Barcelona and Lisbon to slow growth this year and in 2020, respectively. At the other end of the spectrum, though, note that Amsterdam, Hamburg, and Frankfurt dropped below zero in 2018. That's because we expect withdrawals and conversions to other uses to outweigh completions. Overall, though, we see Eurozone office vacancy dropping in both 2018 and 2019 before stabilising. In the retail sector, however, there are more reasons to be concerned. The sector is facing renewed structural headwinds, with many retailers suffering from a fall in physical store visits. This is particularly pronounced in the apparel sector and reflected in recent letting trends, as you can see here in a reduced share of clothing lettings in Germany. Many service-type operators are growing. They tend to require smaller units, though, so that means that landlords of shopping centres and retail parks, in particular, need to ensure they curate their space smartly to remain relevant to today's and future shoppers. At the same time, prime high street rents, which have grown strongly, are showing signs of weakness in places like Germany and Norway, perhaps as rents have been pushed too far. And with consumer spending growth to slow a little in the coming years, the sector will also face some cyclical pressures. Now, to a certain extent, retail's loss has been industrial's gain, with take-up, particularly from retailers and logistics specialists, becoming a large and growing part of the market. We expect this uplift in demand to be prolonged as online growth continues. Admittedly, we expect a fairly pronounced supply response, as we've already seen in speculative development pick up in some markets. But the overall rental prospects for industrial property are better than in the past, particularly for urban logistics. And on that more positive note, I'll hand over to Hamish to consider how the next few years might shape up.
Looking at the investment side first, higher interest rates, and in particular faster than expected rises in interest rates, are a key concern for investors. As we had anticipated last week, the European Central Bank outlined its plan to further reduce its monthly asset purchases in the final 3 months of this year, with the intention to bring its quantitative easing program to an end in December. However, the ECB also made it clear that they are in no hurry to raise interest rates, pledging to keep rates unchanged at least through to the summer of next year. Now, this actually chimes with our own expectation that the first rate hike will come in the second half of next year, probably around September. Following the ECB's announcement last week, markets also expect a similar timing for the first rate hike, having previously expected the ECB to move a little sooner. Now, with monetary policy tightening, we expect government bond yields will continue to rise over the coming years, albeit at a fairly gradual pace. As shown in this chart, government bond yields have moved to a higher level since late 2016, although they have eased back a little more recently. And in part, that reflects the relatively poor start to the year for the Eurozone economy. But nonetheless, with interest rate hikes edging closer, we expect risk-free rates will also move higher, albeit not dramatically. Taking German bonds, for example, we expect them to reach just 1.25% by the end of 2020, up from around 0.4% currently. Now, we know that higher risk-free rates tend to be associated with higher property yields, and as we have set out in the past, we think that the recent ultra-loose monetary policy environment has put significant downward pressure on property yields over the past 3 to 4 years, as investors hunt for higher yielding assets. Admittedly, it is also the case that property can do well in times of strong economic growth, as investors benefit from rising rents. So what do we think? How do we think that these two offsetting factors will affect the outlook for property yields? By using a simple model that incorporates government bond yields and changes in the unemployment rate, which we use as a proxy for economic activity, we can get a sense of the impact of our economic forecasts on property yields. The black line in this chart shows the modelled office property yields based on government bond yields and changes in unemployment. As can be seen, the modelled yields show a fairly good relationship with the actual trend in Eurozone office yields, which is represented by the blue line over the post-financial crisis period. On the basis of our forecast for risk-free rates and unemployment ahead, the model suggests that property yields are probably close to a floor and are likely to start heading higher soon. And in fact, this tallies quite closely with our actual property yield forecasts, which are shown by the light blue line. Indeed, we think yields will find a floor this year before starting to gradually move higher from next year. Turning to the occupier side, as Kiran mentioned earlier, we think that economic growth is likely to slow over the next 3 years, and that can be expected to act as a headwind for occupier demand. Now, to be clear, we are still fairly upbeat on the prospects for rental growth, as the economic outlook is not forecast to see a dramatic deterioration. But as occupier demand starts to soften and new developments enter the market, we expect that this will take the edge off rental growth prospects across the 3 main sectors. And as Kiran mentioned earlier, we expect that the Eurozone office market will tighten a little further. But in fact, it's the slowdown in the rate at which the vacancy is falling, which is consistent with slower rental growth ahead. And just in saying all of that, in terms of the industrial sector, rental growth will, at least at the aggregate Eurozone level, still be stronger than in most years since the financial crisis. However, Taken together with rising yields, capital values are forecast to peak over the next 12 months or so, before starting to drift lower from 2020 as rental growth isn't sufficient to offset the negative impact from higher yields. But with property yields only expected to rise gradually, we aren't expecting a sharp correction in pricing. Turning to total returns, the industrial sector is expected to outperform the office and retail sectors in general on account of the higher yields on offer. But one way to gauge the best and worst markets is to compare expected total returns against the current yield on the assumption that the current yield is correctly priced and provides a reasonable gauge of market risk. In other words, we can look at which markets are generating sufficient returns given its level of risk and those which aren't. So this scatter chart shows for the European office markets, which are represented by the dots, our forecast for annual total returns over the 2018 to 22 period plotted against the vertical axis, and they are measured against the current yield, which is on the horizontal axis. The dashed line of best fit implies from our forecast the average annual return that would be expected for a given level of risk, or the yield. So a dot that is above the dashed line indicates that we expect total returns in that city to outperform relative to the city's level of risk, while a dot below the dashed line implies that the market is not generating sufficient returns for its level of risk and is therefore expected to underperform. On the chart, the blue dots represent Eurozone markets, the black dots are Nordic and Swiss markets, and the grey dots are markets in the CEE region. Just taking a couple of examples. As highlighted by the larger red dotted circle, the Nordic markets, together with Amsterdam and Madrid, are forecast to provide returns in excess of what might be expected given their level of risk. By comparison, some of the core German cities, along with Paris, are only expected to perform in line or even slightly underperform. The two Swiss cities, Zurich and Geneva, are forecast to be laggards, as is Dublin, where the large office development pipeline is a key factor which drags down the city's relative performance. Poor rental growth prospects also weigh on the relative performance of the Warsaw and Krakow office markets. By doing the same analysis for the retail and industrial sectors, this table shows selected cities that are expected to be some of the best and worst performing markets. Just to highlight one or two, in the retail market, Paris is expected to outperform on the basis of a fairly upbeat outlook for rental growth. Total returns in Copenhagen and Lisbon are also expected to outperform. In contrast, given our downbeat assessment on rental growth prospects in Germany, we expect the likes of Hamburg and Frankfurt to be amongst the worst performers in the retail sector. Copenhagen also stands out in the industrial sector as being a strong performer, together with Dublin and Budapest, while the Swiss and Polish cities are forecast to provide poor returns, in part due to the weak outlook for rental growth. So to conclude, there are some initial indications that cracks might be about to appear in European property markets, and that the market is reaching an inflection point. In particular, investment activity appears to have peaked in Western European markets, and yield compression looks pretty much done. Although the overall economic environment is still positive, slower economic activity ahead points towards softer occupier demand. Indeed, we think that the best days for rental growth are now behind us. And with the prospect of higher interest rates ahead, we think that higher risk-free rates will put upward pressure on property yields. That is not to say that we think a sharp correction is around the corner. With risk-free rates only expected to rise gradually, the rise in property yields should also be fairly modest. So that concludes our presentation, and so we can now move on to our Q&A session.
Okay, well, I have a number of questions in front of me here. A few of those we've received in advance and one or two during the presentation itself. But if there are other questions that anybody has, then please do send them through the Q&A widget. So I think the first one should be directed to you, Hamish. And there's two questions here that are related about where the cracks are actually appearing. So the first one or first part is specifically on Germany. And then the second asks that if there are signs of cracking, which countries face the deepest cracks, and will those cracks appear all at once?
Okay, well, I'll start with the second part of it first. And if we think about, so say, the investment side of the market, so our general outlook is that we think the market is close to a turning point in general. So in other words, as risk-free rates sort of arise across the board, across European economies, we think that will affect the overall property market as well. Now, of course, there will be country-specific factors which will weigh on individual markets. So one example that we've already touched upon is the large office development pipeline in Dublin. And that's, as a result, we expect rents to actually start falling in 2019 and 2020. But even as as economic growth slows, it's quite possible that some of the weaker economies may struggle more. And of course, there's also the potential for sort of resurfacing of political risks, such as what we've seen in Italy recently, and that could also affect the relative performance of individual markets as the cycle begins to turn. Now, in terms of Germany, we have already started to see some weakness, particularly in the retail market. We saw prime rents in a number of the main markets fall towards the end of last year. Although those falls themselves were still fairly limited. But nevertheless, given the fairly healthy rates of consumer spending growth in Germany, we would normally expect that to be associated with fairly solid rates of rental growth. At the same time, letting volumes in the main cities have also been trending down over the last couple of years as well, as competition from online retailers begins to sort of bite and reshapes the high street. In addition, although the Berlin office market could also be one to watch, although the market itself is very tight, vacancy is very, very low, the city does have a fairly healthy development pipeline. So that could potentially see the rate of rental growth slow quite sharply over the next year or so. So that, I think, again, is one to watch in Germany.
Okay, thanks, Hamish. Just to let everyone know that we will be sending out making the presentation and slides available following the presentation, so that will be sorted. A question that's come in advance, which I should probably take, is regarding the Nordic countries, asking how they're positioned in the current cycle. So what I would say is, on the valuation measure that we showed at the start of the presentation, the Nordics markets were all overvalued in Q1 across all three sectors. But that valuation measure is based on current income streams and previous relationships with alternative assets. So if you factor in our short-term rental growth forecasts, particularly for offices, where we think short-term rental growth should be particularly robust, then you saw on Hamish's slide before that those office markets are some of those that are expected to outperform for their level of perceived risk. But actually, if we look within the region, we can note that Stockholm looks more late cycle than the other markets for sure. Their transaction volumes have already fallen sharply, as I noted at the start. Prime yields have been been flat for the last year or so, and therefore may have reached a floor. And interest rates are likely to rise amongst the soonest in Western Europe. And actually, one of the documents in our resources list is one we wrote in February, is Sweden the canary in the coal mine, looking about whether Sweden might be a leader in terms of seeing risks to yields on the upward side. And we could contrast that with a couple of specific other areas in the Nordics. So one would be the Copenhagen industrial market, where we have pretty strong prospects for rental values, given that rent levels there are below their neighbours, and there's very good close proximity to a number of large cities. So with the changes in the logistics sector, that's becoming an increasingly strong market. And yields for Copenhagen industrial are still relatively high by European standards. So the prospects for returns there look pretty good in the next few years. And the other place would be Finland, where there's been some pretty decent yield falls in the last few quarters. But it's also worth noting that the economic recovery of the last year or so is going to drive pretty decent rates of rental growth. And it's fair to say that Finland, because of its previous poor performance economically, is behind the curve in terms of yield falls and occupier demand compared to places like, in particular, Sweden. One other one that I should probably cover off is Is Europe more or less attractive than the UK for non-UK investors? So I think it's worth saying, obviously we all know that the UK still has the Brexit cloud hanging over it, but actually investment activity there has recovered fairly well since the post-vote slump. And actually, as a result, there's probably been some benefit for overseas investors from the weakness of the pound. And actually, there was some evidence I heard this morning that 3 of the 5 largest high street retail deals done in the UK last year were purchased by overseas investors. What's more, if you look more generally at Europe and the various mini political crises of the past few years, they tend to show that investors are fairly happy to actually look through political risk on the proviso that the economies and by proxy their investments are backstopped by central banks. Now, as long as central banks act rationally and consistently, then that's fine, and it should mean that Brexit, for example, doesn't have a huge impact on the UK investment market. That being said, whereas the UK and London specifically have been heavily overweighted by foreign investors in the past decade, there are reasons to think that maybe that degree of overweighting should reduce as prospects in other European countries improve, and those of the UK could perhaps be a little softer over the next decade than might have otherwise been the case. So Hamish, another one for you is that sooner or later interest rates will really rise. By that, I'll assume the question assumes they rise quite sharply. So what will be the impact on real estate yields?
Also, as mentioned, we do expect interest rates to start to rise next year, putting upwards pressure on government bond yields, which we expect to feed through into higher property yields. Now, in terms of interest rates and the speed of interest rate rise, it's always important to think about what is actually driving the pace of interest rate rises. So, for example, if there was to be a sharp pickup in Eurozone inflation, that could indeed prompt the ECB to act quicker than it may otherwise be prepared to do so in order to contain the inflationary pressures. Now, if that was to be the case, then I think we would expect to see quite a sharp repricing in risk-free rates or in government bond yields as a result, and we'd expect that to put increased pressure or increased upwards pressure on property yields. At the same time, because the higher interest rates, or much higher interest rates, might also result in a sharp slowdown in the economy, putting significant pressure on retail growth prospects, and that could also be expected to lead to a reassessment by investors in terms of required returns.
Thanks. It's actually, I think it's also worth noting that we think that there's been a structural decline in equilibrium interest rates since the financial crisis. So this means that central banks won't need to raise interest rates to such a high level as in the past in order to achieve their objectives around price stability and full employment. And it also means that required returns on risk-free assets are also likely to be lower. So as higher risk-free rates put upward pressure on property yields, the peak in property yields is actually likely to be lower than in previous cycles. Just before we finish up, I'll just mop up a couple of the questions that have come in latterly. So one asking about whether capital allocations towards real estate are continuing to increase and whether that's been factored into any of our forecasts. Certainly our forecasts as part of the derivation of them assume a long-term increase in allocations from pension funds, and that's something that we're certainly very much aware of here, and obviously one of the key drivers of demand in the last few years has been much more on the equity side than the debt side. And finally, just there's a question regarding how we determine whether sectors and markets are overvalued or undervalued. And the answer comes back to our valuation analysis. So we produce a quarterly valuation monitor, which clients would have received the latest version of about 3 weeks ago, but is available on our website. That highlights the current position the end of Q1 position in all of the markets that we cover across the 3 sectors. There's also a back page there that highlights the methodology of our valuation monitor. And it also refers to a focus piece that we put out in 2015, I think it was, which actually goes into more detail and more depth in terms of explaining how we derived the valuation monitor. So I'd direct clients to find those on the website first, but obviously we're happy to take calls on that or discuss that further if need be. Okay, I'll just hand over back to Hamish then.
Okay, thanks, Kiran. Unfortunately, we have sort of run out of time. We have had a few more questions come in, but we will get back to the people who have asked those. We'll send you an email later today or early tomorrow to reply to those questions. So just a note to say that we can, clients can also follow us on Twitter at CapEconProperty. And that just leaves me to say thank you all for tuning in today and goodbye.